And Max Keiser, this is the Keiser Report. I think if you go through the record, you'll find that for the past 5 years, we've been the only media outlet in the world to accurately predict that interest rates are going to continue to go down, that central banks are going to continue to buy securities, and that money printing would continue and that inflation would break out. And this is exactly what's happening. And now we've got some updates. Stacy.
Yes, money printing will continue until morale improves. And basically, this is the message from Joe Biden, the President of the United States, to Jerome Powell, the head of the U.S. Central Bank, the Federal Reserve Bank. Biden, the Fed, should take whatever actions are required to help the economy recover. So whatever it takes, he's saying to the guy who all he can do is print more money, issue more credit, right? It's not like he's going to go out and build a plant, a manufacturing plant, and produce wealth. No, he's just a guy who could issue more credit.
Yeah, I mean, it's fascinating because when the President of the United States is talking about helping the economy,
yeah.
Okay, what does he mean when he says the economy? Okay, what is he talking about? And because, as you point out, the jobs have been shipped to China. The insurance companies and bankers have been engaged in wholesale gouging and price gouging and larceny and fraud, unchecked. The money printing is the problem, and what Joe Biden is suggesting that to address the problem, he wants to double down and triple down and do more money printing, right? So what lunatic asylum does this man live in that Jay Powell lives in? What wing of the psychotic no man's land are they residing?
This is just called, bubble. They live in a bubble, literally and figuratively, where they're only hearing their own ideas, that academic Keynesian sort of economics. That is the only answer and the only cure. And if it didn't work the last time, it's because you didn't print enough. So they keep on doubling down. And in fact, we're going to look at this fact. The Fed's balance sheet more than doubled since 15 months ago, from roughly 4 trillion to over 8 trillion. Nothing to see. As you can see, they're doubling down in the past year on their failed policies. And of course, the bond markets that we always refer to as like much bigger than the stock markets, though the ordinary citizen will look more at the stock market because they have a 401k, maybe a little tiny one compared to the vastness of the stock market. But the bond market is even 2 or 3 times bigger than the stock markets. So the bond markets, started this week with a pretty contrary message to all the inflation talk, which is that they said, rates, the yield plummeted down to under 1.2% on the 10-year. So that was a huge move and shocked the markets. And that's what prompted, I think, Biden to say the Fed should do whatever it takes.
Right. I think that's where our work as journalists have come in really handy for people trying to make sense of it all. Because the purchase of bonds by the central bank to drive the interest rates lower, we've been saying now for 10 years, we've had guests, and going back all the way to Peter Schiff in 2008, who predicted inflation would break out because of all the money printing. And that was the consensus now for 10 years. And we've had probably 50 experts come on this show and say bond market's topped, interest rates are going higher. And they've been wrong 50 times in a row. And they're wrong again this week because the 10-year bond is hitting another new all-time low, and it's heading to under 1%. It'll probably head to under 0.5%. And is that deflationary? Well, it's not deflation or inflation. You've got a rogue, psychotic central bank printing money to buy bonds to keep rates low to appease the crocodiles in the hedge fund industry who are buying up huge swathes of the economy for their private gain at the expense of the public good, and we're turning into a neo-feudal hellhole, if I may use that expression. So it's not inflation or deflation. It is, however, causing A, price shortages, and B, price inflation that is, in fact, disenfranchising and impoverishing millions more Americans, Joe Biden.
You said price shortages. There is definitely a shortage of accurate price signals, but there are supply shortages. And this is the interesting thing. So 15 months into the doubling of the balance sheet of the Fed, the loosening of money, the sending out of stimulus, right? So trillions of dollars, over $6 trillion was sent to American households. And now we're starting, nobody's been working. We've been in lockdown. Nobody in the UK, nobody in lots of parts of Europe, Australia, locked down. Somebody has to make that stuff for us, though, that we're spending all our stimmy checks on, right? Well, this is interesting stuff from Wolf Richter, because he loves that sort of supply data. He loves it, and it's a good site to go to, wolfstreet.com, and check that out. Plunge of retail inventories, collapse of new and used vehicle inventories. Turns out when the US government spends $5 trillion in borrowed fiscal stimulus over 16 months, and the Fed hands out $4 trillion in monetary stimulus over the same period, causing asset prices to boom, demand for goods is going to wash over the land in tsunami-like waves, and supply chains that snake all over the world amid finely honed just-in-time inventory strategies get tangled up. And as retail sales spiked in a historic manner, shortages of all kinds have been cropping up, including the semiconductor shortage that has slammed the auto industry with a vengeance.
Right. This is so messed up because the money printing, $6 trillion. Okay. So it goes into people's pockets and they go on a mad shopping spree for washers, dryers, and cars, things like this, which are manufactured in China. And so Chinese GDP is up. It's up 18%. The US is flat. So we're printing money and sending it to Chinese workers in Chinese factories until a moment when they develop shortages. So now there's shortages of goods like microchips, essential goods to make the economy work. There's shortages from Taiwan, from China. And so in response, the government's and Joe Biden is telling the Fed to go print another 6, 12, 20, 30 trillion dollars. Do whatever it takes, okay? That means that we're gonna send another $20 trillion to China. We're gonna cause another panic, but China is gonna say, you know what, since all that stuff's in shortages, we're gonna raise prices, right?
Yes.
So China's raising prices now. They're the ones who are dictating prices. So we're creating a monster here. We created a freaking monster. We've got China, economy zooming. They can raise prices at will, and no matter how high China raises prices for Americans to buy their goods, Biden's going to print more money to send to China. This is the worst dystopian Chinese finger trap that's ever been invented by two lunatics.
But on the other point here, like we talk about the price signals all the time, and this is what has really set off this Bermuda Triangle of, like, do we know if it's inflation, deflation, what's up, what's down? Is our GDP increasing or decreasing? Is it all, in order to understand where you are in the context of the economy and history of the economy, you need some stable point, but we don't have stable points anymore. So manufacturers and retailers they're actual business people, right? They have to turn a profit. They have to pay their shareholders. When this pandemic hit, they just look at history of what happens when they shut down their shops and everything. They assume people aren't going to spend. That happened in 2008. The consumer stopped spending. There was a crash in spending for about 12 to 18 months. They didn't count on the trillions of dollars going out. So the supply of inventory, they didn't order it thinking, like, as we've covered with the semiconductor chips, they just assumed that nothing would happen, right? They didn't count on the Biden bucks, the Trump dollars. They didn't count on all of that stuff. So now it's being drawn down and gobbled up, but people have so much cash, not only because they haven't spent in a year, but they're trying to spend it, get whatever they want. They have pent up demand, and you're seeing that in the total inventories at all retailers, from auto dealers to supermarkets, fell to $598 billion worth in May, seasonally adjusted, which is down 9.8% from May of 2019, the third month in a row of declines, but still up from the low of June of last year. These inventories in May and retail sales in May, which had declined from April, produced the second lowest inventory to sales ratio in the history of the data going back to 1992, the lowest having been in April. So here's his chart of the inventory to sales ratio. And I mean, you just know that looks crazy, right? It looks, we were seeing odder and odder charts. It doesn't matter what it is, whether it's the price of money, whether it's the price of energy, whether it's their inventory, whether it's whatever. We've seen crazy charts over the past few years, and this is yet another one. Hopefully, we could all endure, get through possible Delta variant lockdowns and more stimulus checks, because it looks like the inventory is being depleted.
That's what's causing the ability for China to have price, flexibility to raise prices. And so it's also feeding massive corruption, because the people who are closest to the money printers here in Washington, D.C., they're price insensitive. No matter how high China raises the prices for any product, the people in Washington, like Nancy Pelosi, whose husband has been trading on inside information now for a few years, and her net worth went from 40 million to over 100 million. Yeah. It's fully documented. It's legal for her to do so. It's not illegal to trade on inside information. She doesn't care if China raises the prices of washing machine or doubles or triples. She just has her husband write a check, and he calls Wall Street and says, "What's the hot tip?" And then they send him a few $1,000s, and then she buys her washing machine. She's immune to it.
But the point is, like, if China has to shut down again, like the amount of basically we've been depleting the inventories over the past year, and everything seems to be okay. Just send stimulus checks. People are going to assume that based on the past 12 months, we can just keep on sending stimulus checks and everything will be fine, because there's always something in the supermarket, at the shop, whatever. There's always something to buy. But at the end of the day, can we tolerate another break to the supply chain globally, to globalization, to these ships arriving with goods from China? Like, we're all counting on them not having to lock down again, while we ponder whether or not we should lock down again.
No, that would be equivalent to a meteor strike, essentially. It would be like a meteor hitting planet Earth if we have another complete breakdown of supply chains as we did during COVID. If we had another one now, it would be equivalent to a meteor striking planet Earth. That's what would happen to the economy.
Whatever it takes. That's what Biden says. Whatever it takes,
Biden,
man.
If a meteor struck planet Earth, Biden would call the Fed and say, "We need you to print $500 trillion right now because of this meteor." And Jay Powell, who would be a cinder sitting on a box next to a vault with nothing but hamster poop, would be unavailable to accommodate him.
Well, whatever. This is what they believe. They think we need a world war or alien invasion. This is the Keynesian academic thinking I was telling you about at the top of the show. This is whatever it takes is something like that. So don't give them ideas, Max.
No, go long hamster poop. I understand that's the new Modigliani. All right, we're going to come back after this break. Don't go away. Hi, welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Tavi Costa. He's a portfolio manager at Crescat Capital. Tavi, welcome.
Well, Max, thanks for having me again.
All right, yeah. Let's follow you on Twitter quite closely, and you've got some great insights into these markets. The 10-year Treasury yield has plunged under 1.2% on Monday. What do you make of this move, despite the trillions already printed in the past year? What does it tell us?
I think we're reaching what I thought we would, which is sort of a stagflation scenario. I think the 10-year yields is reflecting some of that. But also there's a lot of folks looking at the 10-year yields and thinking that represents a lot what's happening with the inflation picture. I think that's really off, considering the fact that the Federal Reserve is still buying $120 billion of QE. In other words, $80 billion of treasuries plus $40 billion of mortgage-backed securities. I also think it's interesting to see how the copper to gold ratio, which follows the 10-year yield very closely throughout history, now diverging, showing perhaps that 10-year yield should be higher, not lower than where it is today. So I think there's a lot of things going on, but the suppression of interest rates, which in my view continues to be the real mandate of the Federal Reserve, more than anything else, of stability of inflation or maximum employment, I think that continues to be the case. And we're seeing that in a huge way. But on top of it, we're seeing now some of stagflationary signs where the inflationary, I would say, forces are still kind of sticky and gaining momentum, in my opinion. While at the same time, we're seeing, the economy showing off signs that perhaps is close to deceleration than anything else.
So for folks who are not up to speed on stagflation, we haven't seen it since the 1970s. What's the 1 minute definition?
that would be, it's something that it's difficult to see throughout history in a very long period of time, but it's something that happens every now and then, and that is when economy is decelerating significantly at the same time, or not growing at a very fast pace. At the same time, we're seeing inflationary forces either growing or at levels that are much higher than the levels of growth, economic growth. And we're talking nominal growth at this point. So real growth actually becomes negative, which is kind of the case right now. If we look at the own Federal Reserve PCE nowcast, it's running at a much higher level than their own GDP nowcast calculations. And so that is one of the signs that we're seeing the beginning of stagflation. Obviously, the economic activity has been very hot recently. So that is not necessarily where we are currently, but I think we're leading towards that direction where the economy will continue to decelerate a little bit more. At the same time as inflationary forces will continue to stay where they are or gain momentum from here. So, why does that all matter? If you look back in the 1970s, we're all looking for an analog for what's happening today. And a lot of folks like to look at the 70s, but I think we're in an even more extreme situation that we saw back in the 70s. Back then, the government debt to GDP level was about 30%. Today, we're about 128% of GDP just on the government side. And so back then, when inflation got up to 5%, we saw interest rates and the Federal Reserve calling it transitory, number one. But they did raise rates from 6 or 5% all the way up to 13%. This time around, I don't think they can do that. What are they going to do? Shock the world and raise rates to 2%? I highly doubt they're even able to do that. So I think we're going to see even more extreme policies reinforcing the inflationary environment, and why I believe that at some point we're going to reach this stagflationary environment. And I think the 10-year yields is pointing towards that direction.
So President Biden has said that the Fed should take whatever action is necessary to help the economy recover. Okay, this is problematic for a couple of reasons. First of all, corporate earnings are at their highest in history. So what's he talking about in terms of that? What does he think the Fed can do? I mean, other than print, there seems to be a disconnect between Joe Biden's brain and what the Fed can actually do.
I agree. And I think there's an agenda here for inequality. There's an agenda for the green situation of spending on environmental issues and climate change problems that, especially the political environment thinks that they should be doing. But on top of it is this dependency on the economy of not having organic growth, and therefore needing a lot of monetary and fiscal stimulus, which continues to deteriorate the labor shortage issues and some other three pillars that I call of inflation, the demand pull, where we're seeing this transfer of wealth from the government to the private sector, and mostly the bottom 50% receiving a large percentage of that capital. Obviously, the inequality is still a big issue. When I said the stuff about stagflation on corporate profits being at the levels that they are right now, I was just referring to the level where I think we're going to be in the near future. But I agree with you. The economy is really hot right now. And what is surprising is the difference between wages and salaries and corporate profits, which makes me believe that one of the big reasons why we haven't seen inflation is a steady decline of wages growth for the last 30 years. I think we're going to see a change in that environment in the following years. And that's going to, again, become another pillar of inflation that is going to be it's going to reinforce that strength. On top of the debasement of money here that we're seeing in a huge way, and the monetization of that, in my view, that is in process. And so I don't know necessarily what he means by recovery. If we're already, any person with a brain looking at only the job numbers and inflation numbers, it's pretty clear we're already returned. We already had the recovery. It's going to be difficult to see another 6 months like we saw the prior 6 months again, unless we're going to see a major amount of fiscal and monetary stimulus, which is possible again. And so I'm very focused on the dilution of money and what the consequences are of that. When you have this change of this transfer of wealth, along with the labor shortage, along with the bottlenecks and the supply issues, along with monetary debasement, and the increase of deglobalization, I think all those pillars are very inflationary. And I think they're very different than what we saw in the last decade or so. And so that for me is where the focus is from a capital allocation perspective.
And of course, in the 70s, you had wages up, right? So inflation was kind of pulled by a wage increase spiral. And of course, you had an era of very strong labor unions. And actually, if you look back, the wages in the 1970s for vast majority of Americans were, relative to all other metrics, very high. Since that time, since the 1980s and the deregulation of the markets with the Reagan-Thatcher era and financial engineering, has been able to neuter wages, the labor movement as such. And it seems, I'm curious what your take is here. Joe Biden focusing on social justice warrior stuff, a lot of arcane, esoteric things I can't even get into. He's basically saying that we think here at the federal government that you, the American person and population, we want you to be able to feel comfortable teaching things in your primary school, but we're not going to allow you to have a job that pays a decent wage. That's the trade-off, right? And Americans are buying it. They're saying, actually, we don't want jobs. We don't want to survive on income. We want to be able to explore all kinds of freaky stuff instead. That's the quid pro quo. And they're getting away with it, shockingly. Tavi, your thoughts?
Well, look, it's incredible to me, even when you use as an analog what happened during the Spanish flu too, this issue with especially protests from the labor side. 1 out of 5 workers back in the 1919 was actually engaged in a protest for labor at the time. And so I think that's another way of kind of guiding us to this scenario. I think we're going to see that. And we're seeing already some sort of pressure towards that. The divergence, again, from, especially if you look at the ratio of wages and salaries minus the direct payment of the government. So you got to remove that part of the picture. And you divide that by the corporate profits. Clearly, we've been in a steady decline. It almost looks like money velocity chart, meaning it's been a secular decline on that. At what point do corporate profits translate into higher wages and salaries? And that comes, in my opinion, from inflationary forces beginning to creep up, increasing the cost of living. And the cost of living increase is what creates the need and the demand from workers to actually wanting to earn more money. And so I think we're at that level today, especially organically. In fact, I think we may be at that level too, with corporate profits at record levels. I think there is a chance we may see that. That's going to change the whole dynamic, especially from a margin standpoint of companies. There's a lot of companies may be squeezed in a huge way as labor costs increases. And on top of it is what you're talking about is this issue with that we didn't see in 1919, which is this massive fiscal policy that turned into a labor shortage where folks are just not willing to go back to the labor force. And so I think that's just exacerbating a natural issue of a secular decline of wages and salaries that is about to change. As we've learned throughout history, especially in emerging markets, and I think a lot of millennials and the younger crowds of the U.S. have not really experienced real inflation. But I come from emerging markets, and I know that when you have those types of programs where you're giving money to the people, especially in the bottom 50%, or from a helicopter money type of policies that we're seeing today, those tend to translate into inflation, and that's exactly what we're seeing now. And then on top of it, you have this issue with not the bottlenecks in the supply chains and all that. That's somewhat transitory. But the thing is, there has been a 10-year, 15-year horizon, as you know, Max, of underinvestments in commodities. And so that issue is something that will continue to replicate into other situations where we don't have exploration of enough commodities to go from the new to the old to the new economy. We don't have the development of mines to the same level that we saw in the past decades. So all those things are coming along together in a time when we haven't seen inflation in 30 years. And so I think that those policies are going to get even more extreme as we go here. And the dependency of the government to continue to provide the income to the population here, especially the bottom 50%, may actually continue, in my opinion.
So you're looking for a much higher breakout of inflation. What's your target on that? And we got about 5 seconds.
I think inflation is going to continue to run higher. I don't think it's going to be hyperinflation, but we'll continue to be at about, hopefully, I think it's going to get to a double digit, actually.
All right. Tavi, Costa, we're going to continue this in a part 2. Thanks for being on Keiser Report.
Thank you very much, Max.
And that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Tavi Costa, over there at Crescat Capital. Until next time, bye, y'all.